Section 2:1 Introduction to Modern Portfolio Theory, Risk and Return Concepts. 2.1 Risk and Return Analysis. In the context of modern portfolio theory, MPT, risk and return are fundamental concepts that play a central role in portfolio construction and analysis. Here are the definitions and measurements of risk and return in MPT. Return. Return refers to the gain or loss generated by an investment over a certain period of time. It represents the increase or decrease in the value of an investment, typically measured as a percentage of the initial investment. Return can be calculated using various methods, including simple return, logarithmic return, also known as continuously compounded return, or annualized return. Risk. Risk is the uncertainty or variability associated with the potential outcomes of an investment. In MPT, risk is typically measured as the standard deviation of an investment's returns. The standard deviation captures the dispersion of historical returns around the mean return. A higher standard deviation indicates greater variability and higher risk, while a lower standard deviation suggests less variability and lower risk. Systematic risk. MPT distinguishes between systematic risk and unsystematic risk. Systematic risk, also known as market risk or non-diversifiable risk, is the risk that cannot be eliminated through diversification because it affects the entire market or a particular segment of it. It is driven by factors such as changes in interest rates, macroeconomic conditions, geopolitical events, and market sentiment. Systematic risk is measured by beta, which quantifies the sensitivity of an investment's returns to overall market movements. Unsystematic risk. Unsystematic risk, also called specific risk or diversifiable risk, refers to the risk that can be eliminated through diversification. It is specific to an individual investment or a particular sector and can arise from factors such as company-specific events, industry trends, or management decisions. Unsystematic risk can be reduced or eliminated by combining investments with low correlations. In MPT, unsystematic risk is not rewarded because it can be diversified away. However, it is an important consideration in portfolio construction as it contributes to the overall risk of a portfolio. Risk-adjusted return. MPT emphasizes the importance of risk-adjusted return, which takes into account both the potential return and the associated risk of an investment. One commonly used risk-adjusted measure is the Sharpe ratio, which calculates the excess return of an investment per unit of risk. It considers the risk-free rate of return as a benchmark and provides a measure of the additional return earned for each unit of risk taken. In MPT, the goal is to construct portfolios that maximize the expected return for a given level of risk or minimize the risk for a desired level of return. By understanding and quantifying risk and return, investors can make informed decisions about asset allocation, diversification, and portfolio optimization to achieve their investment objectives while managing risk effectively. In investment and finance, risk can be classified into different types based on its source and impact on investments. The two main types of risk are systematic risk and unsystematic risk. Let's explore each type. Systematic risk. Systematic risk, also known as market risk or non-diversifiable risk, is the risk that affects the overall market or an entire asset class. It is beyond the control of individual investors and is caused by factors that impact the broader economy or financial markets. Systematic risk cannot be eliminated through diversification because it is inherent to the market itself. Key sources of systematic risk include: A. Market risk. This refers to the risk of general market movements. Factors such as changes in interest rates, inflation rates, geopolitical events, economic indicators, and overall investor sentiment can impact the entire market and cause systematic risk. B. Interest rate risk. Interest rate fluctuations can affect various investments, especially fixed income securities. Changes in interest rates impact bond prices inversely, leading to interest rate risk. C. Inflation risk. Inflation erodes the purchasing power of money over time. Rising inflation can decrease the real return on investments, impacting the overall market and causing systematic risk. D. Currency risk. currency fluctuations can affect investments denominated in foreign currencies. Changes in exchange rates can impact the value of international investments and lead to systematic risk. Unsystematic risk. Unsystematic risk, also known as specific risk or diversifiable risk, is the risk that is specific to an individual investment or a particular sector. It is unique to a company or industry and can be reduced or eliminated through diversification. Unsystematic risk is not correlated with the overall market, allowing investors to mitigate it by spreading their investments across different assets. Key sources of unsystematic risk include: A. Company-specific risk. Factors such as management decisions, operational issues, financial performance, legal disputes, or product failures can impact a specific company's stock or debt. B. Industry or sector risk. Certain risks can be specific to an industry or sector, such as regulatory changes, technological advancements, shifts in consumer preferences, or supply chain disruptions. C. Financial risk. This includes risks related to a company's financial structure, such as debt levels, credit ratings, liquidity, or financial mismanagement. D. Event risk. Unpredictable events like natural disasters, political instability, lawsuits, or accidents can cause specific risks to certain investments. The key distinction between systematic and unsystematic risk is that systematic risk affects the entire market or asset class, whereas unsystematic risk is specific to individual investments or sectors. By diversifying their portfolios, investors can reduce unsystematic risk but cannot eliminate systematic risk, as it is inherent to the overall market conditions. Understanding and managing both types of risk is crucial in constructing well-balanced investment portfolios.